don't have income high enough. You're not saving. You're not investing. You've got a bunch of debt. And I'm like, oh, here's the solution, term life insurance. None of those things got fixed, right? Like it's all still happening. Now I just have an added expense so that if I kick the bucket, my family's not going to be stuck as bad, but it didn't fix anything. Right? So here's the idea behind what's supposed to happen is that you're supposed to save and invest money, right? So here's what I used to teach people. I would say, okay, you have to excuse my message pop up at the bottom that it's my team getting some work done today. So I would tell people, okay, so you are spending over here, right? So you've got expenses. Okay, you also over here, you have income. And over here, you have debt. And over here, you have assets. Right. And so I would show people, like, obviously, you need to have income. If you don't have income, none of this works. Right. You want to keep your expenses down as low as you can. You want to pay off all of your debt. And you want to take as much of the difference here between your income and expenses. You want to take as much of that as you can and put it into assets. Right. Now, this is not complicated, but most people don't do it. And so I would tell people for life insurance, you only need term. Right? Now, what is term insurance? Term insurance is temporary coverage. It's like car insurance. I only have it for the period of time I pay for it. It can expire. Like, for example, if I get a 20-year term insurance policy, after 20 years, my insurance goes away. Right? For the 20 years I have it, I have coverage. Right? If I were to die within the next 20 years, it would pay out. Okay. And this coverage would cover things like it would pay off my debt. It would cover some expenses. It would replace my income, right? It would cover the fact that I lack assets, right? But it doesn't do this. Like, having term insurance does not make me save more money. And here's how I know this, because you could apply the same concept with anything. Okay. So if I am going to buy a phone, I could say, iPhones are expensive, buy an LG and invest the difference. Okay, if I was going to buy groceries, I could say the same thing. Organic groceries are expensive, so go to Walmart and invest the difference, right? Like, I can tell anyone, buy something that's cheaper and then take the extra money and go put it into assets. Like, that's not any sort of financial ingenuity. It's like, okay, yeah, if I spend less money on if I buy, crappy bacon instead of great bacon, I have extra money and I could go invest the extra money. The question is, do we actually do the investing? And then where do we actually invest? And for how long? And do we keep the money? And does it grow? And all these different things come up. And so what most people end up doing usually is nothing, but the ones that use this term insurance concept, they'll have their term insurance over here. And then over here, they give all of their money to Wall Street and banks. Right? Buy term and invest the difference with who? Wall Street and banks. Right? Like, this is not investing. This is retail financial consumerism. Investing means I buy an asset. Like, so for example, we work with a company called Equity and Help. When you invest with Equity and Help, you actually buy a home. You don't put it with Wall Street. You don't put it with the bank. You don't stick it in a fund. Like, you actually physically buy a home, and that's your home, and you're going to have someone that lives there. Equity and Help is going to manage the whole thing and do all of the property management and make sure the finances are going well. But that's your home. You control it, right? So here's the problem: is spending $30 a month on insurance instead of $100 a month on insurance, for example, isn't really helping me buy a home. Right? Like, this is the equivalent of me saying, go buy unleaded gas instead of premium. You'll save 15 bucks at the tank. You could put that towards buying a home. Like, sure, of course, like, all right, but not really. Like, it's going to take me a long time for that to help me in any way, shape, or form. right? So this was the term insurance concept. What is term insurance good for? Because it's not good for nothing. It does have a reason. It is there. So the things that you want to look at with term insurance is, do I need it just for death benefit coverage? And is it for just a specific period? And is it really, that's the only thing I'm trying to solve? I want really cheap life insurance. I don't mind paying for it. It's not going to ever pay me back. I'm not ever going to break even on it. And I just want to pay out of pocket for that. Right now, here's what I would look at, like with the sacred account, with the whole life insurance instead. Okay, so with term insurance, I might pay on it for 20 years. And every month I pay that premium. And I do that for 20 years, right? And so this money is a total cost. So like, let's say that I have, a term insurance policy that is, $100 a month, which is pretty realistic for most people, $100 a month. And I do that for 20 years. Over 20 years, I have spent $24,000 on life insurance. Okay, I will never recoup this. That's a total cost. It doesn't ever pay me back. It's just like buying gas. Like I used it, right? Except with the gas, I actually did use it. With the term insurance, only about a 2% chance that you'll die and need it. Like during the time you have the coverage, right? Why would that be? Because again, back to that first slide I showed you, in the earlier years, you've got risks and you have less assets. Okay, well, between the ages of 20 and 40, I'm not going to die. Like there's a 2% chance. And this is not 2% chance I'm going to die. I'm saying this is 2% chance of those that actually die during the period of coverage on their term insurance policy. Right? This is the actual number. So the insurance companies love this. Okay, 98% profit. So that means that they're pulling in money that they don't have to pay back. There's no obligation. They get to keep that. Right? Now with whole life insurance, if you design it correctly with the sacred account, check this out. So with the sacred account, our minimum is $250 a month, right? So you're going to put in $250 a month, and basically, let's do the same. Let's say year 1 to year 20, and every month you're paying into it. Okay, now what's the main difference here? Of this $250, 70 to 90% of this is immediately available in your cash value. And this $250 grows at a 3 to 5% rate on average every year for the life of the policy. Okay, so let's do the math on this one. We put in $250 a month. We did this for 12 months a year for 20 years. And we contributed $60,000, right? You're like, wow, that's a lot more money. Like you put in 60,000 versus 24, right? So $60,000 spent. But check this out, because this is actually growing, this $250 a month is growing at a 3 to 5% rate for the next 20 years. In 20 years, I have, this would approximately be 91 grand. Okay, over here, I spent 24,000 and I have 0. Like total costs, didn't get any savings, didn't grow for me, none of that, right? Here, I spend 60, I have 91. Now, the other thing that I want to look at here is usually by about year 7, this is what's called my break even. Right? What that means is that if I, at the 7-year marker, I'm doing $250 a month times 12 months. I do this for 7 years. I've put in 21K. And I also have in my cash value, 21K. So let's just like really simplify this. If I put in 21 grand by year 7, and by year 7, I have 21 grand, how much did my insurance cost? 0. Like I have the insurance, it's still there, but I have all of the money that I put back into it. It's available to me. It paid for itself, right? That's why we call this the break-even period. Now at 20 years, I put in 60 and I have 91. Right? So then again, how much did my insurance cost? Well, my insurance in 20 years costed me nothing. It actually gave me $31,000. I costed it. Like it, you see what I'm saying? It gave me more money that I put into it. Now, here's the beautiful thing about this is this entire time, I can take loans against my cash value. So if I have $21,000 here in my cash value growing at 3 to 5%, I can actually borrow against that. My cost to borrow is going to be about 1 to 3% in interest cost, but my 21 grand still keeps growing at 3 to 5%. I can take this 21 grand out and I can invest it. And also still make the 3 to 5 like the money never left. And also I still have a death benefit. And also I still have benefits to be able to pull out money for terminal illnesses, critical illness, chronic illness, whatever it might be that I need. You name it, it's all still there. If you're wondering, what does Wealth Dynamics do? How can we actually help you? Number one, if you haven't gotten a copy of my book, Blueprint to Financial Freedom, grab one now. You can get that down in the comments in the video. You can get the link for that. Finally, if you have a desire to start getting help walking through these different phases toward financial freedom, book a call with my team. Go to our website, set up a call. We're able to help out and answer questions. That's how we can help you. Thank you for watching. Like, share, subscribe. Make sure you turn notifications on, and I will talk to you guys on the next video.